Ladies and gentlemen, the S&P, Tesla, basically everything went crazy today. I mean, in both directions. It was a huge sell-off, massive recovery, massive sell-off, and now a recovery again. Tesla's currently up over 2% here in after hours trading. Yes, we are waiting for Donald Trump's speech in front of the Congress, the State of the Union address. That is going to be at 9 p.m. Eastern Standard Time today. There's also breaking news that came out right after the bell. But before we get into all of that, what's coming next for markets, everything you need to know about tomorrow, because we do have economic data. Some of you guys that hate me are gonna love this. I don't show you this to glorify like zero DTE options trading or whatnot, but I did see an opportunity towards the end of the day. And yeah, Robinhood auto closed me at 3:31, right after 1 minute after I placed this trade. Sure, made $70, but these things ended up going up to $550 a piece. Effectively cost me $2,700 using Robinhood. So be careful if you are using Robinhood. They will auto close you at the end of the day and cost you to lose a lot of money. I mean, these specific options closed at $354, but they were up to like $600. I thought I still had the trade, and yeah, well, apparently it instantly closed me out. If you're ever beating yourself up, just know things like this just happen, apparently. Nonetheless, we do have some breaking news. I don't know about you guys, but I'm getting really sick of the back and forth. U.S. Commerce Secretary Lutnick says Trump may roll back Canada and Mexico tariffs tomorrow. What's the point? Dude, it just... Oh man, this is just hilarious. Like, second time now they go into effect, they get rolled back or get delayed. Lutnick goes on to say that the tariffs are not going to be delayed. There's probably going to be some kind of middle ground. So they're probably going to come down, if I were to imagine, to like 15%. Canada and Mexico are going to agree to some terms, and that's going to be the end of it. And that is why the SPY is up 0.74% in after hours. Tesla up 2.3% in after hours, trading upwards to $278 per share at the time of recording this video. That is the big news. Now, I think we need to establish something. When you're looking at the broader markets, the reason why we have been so volatile, the reason why we have been selling off is really two parts, okay? One is tariffs. The other is economic growth worries. The economic growth worries side, even if the tariff situation subsides, is not over with. And all of the data that we get really over the next foreseeable future is going to be critically important, because at the time of recording this video, the Atlanta Fed GDP Now tracker is tracking negative 2.8% GDP. We all expect that this is going to bounce back up, that we're actually not going to be in negative GDP territory for Q1, okay? But it's possible, and we need more data to tell us, are we negative? Like, are we going into a recession? Basically, everyone on Wall Street has a no recession call for this year. The risk to markets is the economy weakens. And if the economy weakens too much, then you throw doubt and uncertainty into everything we thought was going to be true for 2025. So clearly, I'm not a fortune teller. I don't know what's going to happen, but I can point out major events, when they're going to take place, and what to be watching out for. And first and foremost is tomorrow's economic data. But first, little side note, I think Trump wants to, cancel or lower the tariffs, partly because they were making so much progress in bringing down 10-year Treasury yields, and that kind of reversed today. People's focus was not really on tariffs being a growth hinder. It was tariffs are going to cause inflation. This is really following Target and Best Buy. Best Buy and Target today, first consumer names to report earnings following the tariffs being implemented, said just in the next couple of days that prices are going to go higher. And yes, I do think Trump does not want prices to go higher, but it also is creating more worries about inflation, which will keep 10-year treasury yields higher. So in theory, reducing these tariffs should reduce the potential impact of inflation, and that should be positive to continue to lower treasury yields. Now, if the economic data comes out bad tomorrow morning, that's also going to lower treasury yields, be positive for the bond market, but maybe not as great for the stock market. Now, today was the lowest or slowest day of economic data. Okay, today really wasn't much that went on. You did get the economic optimism index, in which it's basically plummeting across the board, no matter what subcomponent you're looking at. We talked about this in the previous video. Headline number came in at 49.8. The estimate was 53.1. Last month was 52. So you're definitely seeing more uneasiness, more worries out there in the broader economy. And I mean, how could you not, when you're getting policies that are going back and forth as far as tariffs? Like, companies don't know where to invest, how much to invest, what the dynamic of, the tariff situation is going to look like. I mean, tomorrow, let alone a month or a year or 2 years down the line. You really need some clarity to get companies to continue to invest capital. Then you have obviously the mainstream media that is talking about tariffs raising prices, and that gets everyday consumers, everyday viewers of mainstream media products to also be a little reserved. And that is actually what causes recessions, is confidence issues, let alone Doge, which, yes, it's like an alcoholic, okay? I've talked about this in videos before. If you're an alcoholic and you need alcohol every day, well, yes, the withdrawal sucks. And the withdrawal in this scenario is the government's free money, just, pumping out stimulus into the economy, okay? You withdraw from that, you take some of that stimulus back, you're going to have a rough, short period in time. You're going to come out on the other side of that addiction, essentially, in a better place. And that's kind of what our economy is. It's been addicted to this, funny money. And it's really bad for the bond market, obviously. That's why treasury yields have been 5% for years now. A lot of that has to do with the government's continuous stimulus in the economy, right? Running the biggest deficits in a non-war period ever. Like, that is unacceptable. Okay, so Doge needs to do what Doge is doing, but there could be a moment of pain there. I mean, when you're laying people off, when you're, cutting government spending, again, it's like taking alcohol away from an alcoholic. They're not going to have a great, couple of days or weeks following that. Now, news coming out today in After Hours as well kind of reiterates that. The IRS is drafting plans to cut as much as half of its 90,000 person workforce. So you're talking about another 45,000 layoffs. And what's interesting about the jobs report that we get on Friday is for government payrolls, you're only expecting a contraction of 20,000. Okay, last month was positive 32,000. And I mean, you could see that number come in a lot worse. Okay, that's my expectation, and that could really weaken the non-farm payrolls number, which again is going to bring up some of those growth concerns. So as far as the markets on a medium-term basis, I don't see the economy or economic data that is getting better anytime soon. Now, I was actually talking to some people about this, and they're like, well, what about, tax returns? Won't that boost the economy? Not really. And let me tell you why. 50% of the spending in this economy happens in the top 10% of income earners, okay? Back in like 08, in the early 2000s, only 30%, 30% of total spending in the economy came from the top 10% of income earners. Those individuals do not get a tax return. So you're looking at 50 to 70% of people out there that are not going to be getting tax returns. And I would argue people that do get tax returns are going to be a little bit more hesitant to just go out and spend a bunch of money. And I know some of you guys might be thinking like tax season should be good. No, actually tax season is a drag because like me or you or anyone else, you probably have to pay taxes, okay? So it's not exactly this boost to the economy as some people think. Now, tomorrow morning, we do get the ADP employment change. Let me tell you now, it's not as important as you might think. The ADP employment change sometimes correlates to the non-farm payrolls report, but not that often, okay? Normally, when you get these ADP employment reports, the markets don't care too much about it unless it's really weak or really strong. If it comes in line with expectations, it's a nothing burger situation. It doesn't tell you necessarily if non-farm payrolls, the important one for markets, is going to be weak or strong. But ISM services PMIs, this is going to be critically important, especially really since October 2024, you have seen a weakening here with the ISM services. Now, in the prior report, it also looked pretty rough. It says here, and this is the prior report, okay, not the one we're getting tomorrow morning. So I think it's important to just understand the kind of trend and trajectory that we are on. It says here, the ISM services PMI for the U.S. declined to 52.8 in January from a downwardly revised 54 in December of 2024 and well below forecast of 54.3. The reading pointed to a slower expansion in the services sector due to smaller increases in business activity. 54.5 versus 58. This is likely going to bring down these numbers again. Smaller increases in business activity. I don't think this is going to be a super strong area of the ISM services report coming tomorrow. Now, new orders also plummeted last month from 54.4 down to 51.3, and inventories were in contraction territory for the third month in a row, coming in at 47.5 versus 49.4 previously. On the other hand, employment came in better than expected, and new orders came in a little bit better than expected as well, and they increased faster, and price pressures that eased down to 60.4 for the prices paid versus 64.4 in the prior period. They say, quote, poor weather conditions were highlighted by many respondents as impacting business levels and production. Like last month, many panelists also mentioned preparations or concerns related to potential U.S. government tariff actions. However, there was little mention of current business impacts as a result. So they were saying last month that there's not really any business impacts. They don't really know how to prepare for this, but they were trying to prepare for any potential tariff actions. Well, now that reality's coming closer to home. I mean, it's probably, since the tariffs went into effect last night, this survey is already finalized, a couple days ago. You're going to get more details on this. Okay, it may not all be reflected in the ISM services PMIs, but you're probably going to get a substantial weakening across the board. That could bring up more of those growth concerns, okay? Again, you have the ISM services business activity, employment, new orders, and prices paid. Anything below 50 is contractionary. Now, services is 70% of our economy, okay? A little bit more than that. You don't want services going negative. Then you really start to bring up the concern or the risk of a recession. So I think this data is going to be very important coming out tomorrow. Now, maybe the current administration knows that the ISM services PMIs are going to be bad tomorrow. I don't know. Maybe that's why they're U-turning on the tariff policies 12 hours after they're being enacted. I couldn't tell you that, but I'm not super optimistic that tomorrow's data is going to be strong. If it is, I will be utterly shocked with the volatility and the uncertainty that we've had in the month of February. Like, the odds of this being strong are virtually none, in my opinion. And you're only expecting a slight decline from 52.8 down to 52.6. So Kind of crazy. Now, factory orders month over month are also expected to increase, to get better. Last month was negative 0.9%, expecting positive 1.6%. Again, that is something that Wall Street will pay attention to in terms of, how's the economy doing? How's the manufacturing sector starting to do here? Now, the Fed Beige Book comes out at 2 p.m. as well tomorrow, and that is something that a lot of people pay attention to. The Fed has told you themselves. They look through a lot of data. But if you want a better understanding of where the economy is currently at, you can read the Fed Beige Book. That's what Fed Jerome Powell said the last press conference. Like, read the Fed Beige Book. That'll tell you how we're looking at the economy right now. And they haven't been very good recently. So it's kind of surprising the Fed has been so bearish, but we'll have to wait and see. On Thursday, you get the balance of trade, exports, imports, initial jobless claims. That's going to be something else to watch pretty closely as well. You're expecting around 235,000. That would actually be a decline from last week. I'm not super confident we're going to get a decline there. Now, wholesale inventories month over month as well will be coming out. And then on Friday, you obviously have the non-farm payrolls as well as the unemployment rate. You also get speeches from Fed Bowman, Fed Williams, Fed Kugler, and Fed Jerome Powell around 10 a.m. to about lunchtime, 1 p.m. or so. These Fed speakers will be speaking. Now, my concern that I have for markets right now is I think we are grossly underpricing the risk of a larger slowdown here. Now, again, as I've said before here on this channel, you virtually always in the last, 5 decades or so, need a catalyst to push you into a recession. Now, during the Volcker era, 70s, 80s, when inflation was really high, the Fed had to jack rates up a lot. Some would say, the only catalyst was the Fed. And yes, I would say that was a big catalyst because most of the economy was manufacturing, very capital intensive businesses. Nowadays, that is not the case. Nowadays, it is really a consumer economy. Okay. Consumer confidence falling is a problem. Doge, tariffs, cutting off the flow of essentially stimulus money from the government could be a kind of bucket of catalyst that could weaken the economy. Now, no way, shape, or form am I going to say it's a surefire done deal that we have a recession. That's not what I'm saying here. I'm saying that when you ask people on Wall Street, just go listen to CNBC for a moment. They'll say we're at max employment, economy looks pretty good, it's weakening a little bit, but we're far from a recession. The risk is that we get weaker and weaker economic data, and people have to start talking about a potential recession. We're not even really at the point where we're talking about a recession, and I see that as the risk to this market. And I think it's very skewed, okay? There's a big downside risk. The upshot here, is going to take a long time to play out. The Fed's not in a rush to cut rates. It's going to take a while until they see if tariffs are going to affect inflation. And as long as the economy doesn't weaken, they're not going to be in a rush to cut rates. The Fed is not here to pump your stocks anymore. This is not 2022, 2023, where banks are failing and they need to keep asset prices higher to keep confidence up. You're just in a much different dynamic now where I think risk to reward, buying the dip in the SPY, for instance, short term is not ideal. You could fall much lower. Now, buying the dip in quality single stocks could be the move here, okay? Something like Tesla that is down 44% from all-time highs with really misleading headlines that deliveries are down 40 to 45% in Europe and China, when in all reality, they're launching the Model Y. They just started deliveries on the Model Y. Model Y sales have sucked this entire year so far because who wants to go out and buy an older dated product for roughly the same price as a brand new updated product? You don't want to do that. No logical person with more than a couple brain cells would. Okay, so it's not a shocker here. And with that said, I think you've priced in a lot of bad news for Tesla, and I think deliveries get better from here for Tesla, and we will start to see that reflected in even the weekly delivery numbers. And every time it's going to be a positive catalyst for Tesla when sentiment is this low and the stock has fallen this much. Basically, the argument that I would make here is if, again, we do go into some kind of very low growth environment, something Wall Street's not really expecting, Tesla is much better priced for that. Of course, the stock would probably fall further, but how much further? I mean, $200 just to get back there, you'd lose $72 a share. You're getting pretty close to that level as is because you're already down so much. But if the economy does get better and the things are not as bad as what I think what direction they could go in, then Tesla could go up, you know, to $600, $800, $900 per share by the end of this year as Wall Street starts to focus more on Tesla's real-world AI properties. Now, with the option activity in Tesla stock today, it would suggest that people were not really running away from Tesla. They were actually buying some upward call exposure in Tesla. You had 440 different trades from hedge funds and institutions totaling $587.96 million with a positive order value of 64%. Is this, you know, super bullish? No. Is it bullish? Yes. Now, you did have about 400,000 shares that were sold short today by hedge funds and institutions, 1.38 million shares that were borrowed, and 984,000 shares that were returned. Not exactly telling you a whole lot. It seems like a lot of that shorting did take place at the end of the day today, since in the video we reported earlier today that came out at 4 p.m., you actually seen about 300,000+ shares today that were being covered on. So it does seem like the end of the day, that sell-off that we had did bring in some shorts. And this was just a market-wide sell-off towards the end of the day today. And, you know, do you want to know where I bought that put that I was showing you? Right here. Right there. When the SPY was $5.84, it was $2 out the money, and well, yeah. Shout out Robinhood for that one. Fucking awesome. So yeah, I mean, tomorrow I think it's going to be about the economic data more than it's even really going to be about tariffs. It's kind of shocking Wall Street even believes anything that's coming from the Trump administration in regards to tariffs, because it's just, you know, one day here, one day there, one day changed, one day it's back into effect. Like, there's zero certainty at all. And I think it's really just going to weigh on the real economy more than anything else. I think it's going to weigh on confidence, and I think it's going to weigh really on business confidence, okay? If I were, you know, a CEO right now and I'm like, crap, where should I get my lumber? Canada's cheaper, the US more expensive. I don't know if I'm going to have to pay a tariff through Canada. Should I just wait? Should I just run down inventory? Should I overorder? It's really, you know, difficult. Am I going to hire employees during this, you know, uncertainty? That's the last thing that I would be really worried about, okay? So labor market, economic activity, tariffs are a big problem. And who knows? We'll see what comes out tomorrow with a new potential trade deal, and hopefully that volatility dies down a little bit. Now, nonetheless, today you got above your 200-day moving average briefly. You did fall back down towards the end of the day. Tesla closed down about 4.5%. You're up 2.3% in after hours, up to $278.29. 200-day moving average is about $1.60 or so above where we currently are. 200-day moving average at $279.80. You're currently at $278.28. So we definitely want to get above that 200-day moving average. Again, the data tomorrow I think is really going to dictate what happens next for markets. I still could see a bounce from here to that 310, 325 level. And I want to just remind you that while I don't think we're going to soar back to all-time highs, I don't think we're going to continue to crash at this pace. I mean, this is the steepest, fastest sell-off I believe we've seen since, what was it, like 2000 or 2020, something like that. We have not fallen this fast in a very long time. And I do think that sets you up for bounces. but I ultimately think we'll probably continue to fall, but it's going to be a very choppy fall. It's not going to be straight down all at once. It's going to be down. It's going to be up again, back down, up again, back down. Kind of like 2022, hopefully without the bear market that goes alongside it. And really the biggest threat at this point is the economic data and the economy weakening. So let me know what you guys think about this down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.